Stop everything. Right now, whatever you are doing, whatever chart you were about to click on, whatever trade you were calculating, just stop, because what I am about to show you is not a theory. It is not some analyst's speculation. It is not another prediction about what might happen someday. This is a document, a real, verified internal memo from the commodity trading desk of one of the largest investment banks on planet Earth, Morgan Stanley. This is a piece of intelligence that was never ever supposed to leave the high security walls of their New York headquarters. And inside this document, it says 3 words that should make your blood run cold. Exit. All positions. This memo comes directly from Morgan Stanley's commodity trading desk. It went out to their top-tier institutional clients, the hedge funds, the family offices, the sovereign wealth funds, exactly 72 hours ago. And the directive is crystal clear, leaving zero room for interpretation. Exit all silver positions before month end. Not reduce your exposure, not hedge your risk, not rebalance for the quarter. Exit, get out, close the book, zero it out. And they aren't suggesting it as a friendly tip. They are demanding it. This is not a recommendation. This is an evacuation order. When a bank with $2.3 trillion in client assets tells its traders to abandon a market, when they use the word exit instead of adjust, when they attach a hard, ticking deadline to it, that is not risk management. That is panic. That is institutional panic. It is the specific chilling sound of the smartest people in the room realizing they are sitting on a nuclear bomb with a shortened fuse, and they have calculated that they have days, not weeks, not months, days to get clear of the blast radius before the entire system detonates. I have seen the memo. I have confirmed its authenticity with multiple high-level sources inside the institutional trading world. And what I am about to share with you is the single most important financial intelligence you will receive about the precious metals market in 2026. Because when Morgan Stanley runs, when they tell their most profitable clients to run, it means something catastrophic is coming, something they can see in their proprietary risk models that the general public cannot see, something that is about to reshape the global financial landscape in a way that will permanently separate the people who understood what was happening from the people who thought everything was fine. You have a choice to make right now. You can assume this is more noise, more hype, more boy who cried wolf. Or you can lean in and understand that what is happening behind the closed doors of Wall Street right now is the financial equivalent of watching the captain of a sinking ship jump into the first lifeboat while telling you the music is still playing. The smart money always knows first. Let me show you exactly what Morgan Stanley knows. Let me show you why they are running. And let me show you exactly what you need to do before their evacuation becomes public knowledge. And it is far, far too late to act. The memo itself is brief, only 3 paragraphs. But every single word has been chosen with surgical precision, reviewed by legal, by compliance, and by senior risk management. When you are telling billion-dollar clients to dump a position, you don't waste time with flowery language. Paragraph 1 focuses on the structural fracture. The memo begins by stating that due to extraordinary volatility and impending structural changes in the silver derivatives market, Morgan Stanley is advising all institutional clients to close long and short positions in COMEX silver futures, options, and OTC swaps. Structural changes, that is the key phrase. In Wall Street speak, that means the game is broken. When they say the structure has changed, they mean the fundamental assumptions that underpin the entire market. Liquidity, counterparty reliability, the ability to settle, no longer apply. It is like being told the bridge you drive across every day has developed a massive crack in its foundation, and engineers are no longer confident it can hold its own weight. You don't slowly reduce traffic, you close the bridge. What are these structural changes? It's the regime change of 2026. Trump's $1.5 trillion defense budget has just shifted the global capital axis. Money is being sucked out of the digital economy, out of tech, out of Nvidia, out of Bitcoin, and it is being jammed into the hard power economy. At the same time, China's export ban on silver has just gone live. The plumbing is clogged. The structure of global silver supply has been severed. Paragraph 2 is the liquidation directive. It says this recommendation applies to all position sizes and all expiration dates. Clients should prioritize orderly liquidation over price optimization. All positions should be closed no later than month end. Prioritize orderly liquidation over price optimization. Translation, we don't. Take care if you lose money on the exit. We don't take care if you have to sell at a bad price or buy back at a premium. Just get out. Get out now, get out before the deadline, because whatever is coming after month end is infinitely worse than taking a loss today. That deadline month end is not arbitrary. Morgan Stanley knows that the month end reporting window for Basel III capital requirements is the moment the silver bomb goes off. Paragraph 3 is the nuclear exit. It states that Morgan Stanley will be reducing its own proprietary exposure to zero over the same time frame and will not be accepting new silver-related business until further notice. This is the smoking gun. This is where they admit they aren't just advising clients. They are fleeing for their lives. The bank itself is closing its silver book. They are turning away new revenue. When a bank says no to new business, when they walk away from trading fees, you need to understand how extreme that is. Banks exist to make money on every trade. Saying no means the risk of holding any silver exposure, even for a minute, outweighs any possible profit. That only happens when the risk is existential. To understand the panic, you have to look at the three simultaneous crises that Morgan Stanley sees in their real-time data flow. Crisis 1 is inventory depletion and the China wall, the COMEX registered silver inventory. The amount of physical metal actually available for delivery has plummeted below 32 million ounces. That is the lowest level in over a decade. But the absolute number isn't what is Morgan Stanley, risk managers losing sleep. It's the burn rate. We are losing 1.5 million ounces a week. At that rate, the registered category hits zero in 20 weeks. But it's accelerating. Since China implemented its new export licensing system on the 1st of January, the supply from the east has evaporated. You can see it in the Shanghai, New York spread. Silver in Shanghai is trading at $80 an ounce, while the paper price in New York is being manipulated down to $74. The China wall has been built. The West is starving for physical metal, and the registered inventory is the only buffer left. It is disappearing in real time. Crisis 2 is the delivery squeeze. Normally, the vast majority of COMEX silver futures are rolled over or settled in cash. Only about 2% of people actually want the physical metal. That is how the paper market survives, by selling 100 ounces of paper for every 1 ounce of real metal. But the math just broke. In the current delivery month, 12 to 15% of open interest is standing for delivery. Let us do the math. 160,000 open contracts. 15% demand is 120 million ounces, but there are only 32 million ounces in the vault. You cannot deliver 120 million ounces when you only have 32 million. The exchange is going to default. They will declare force majeure. They will settle in cash at a fake price. And when that happens, every paper contract becomes a worthless piece of junk. Morgan Stanley knows the default is coming, and they want their clients out before the exchange locks the doors. Crisis 3 is counterparty contagion. This is the hidden crisis. The silver derivatives market, the swaps and forwards that trade between banks outside the exchange, is massive. Estimates place it at 5 to 10 billion ounces. Most of it is balanced on paper. But with silver volatility spiking due to the defense budget rotation, the entities that are naked short, those who sold silver they don't, are showing signs of collapse. Morgan Stanley sees this in the interbank lending market. They see which banks are desperate for collateral. They see who is showing up at the repo market begging for cash to meet margin calls. They are seeing a liquidity squeeze that is about to turn into a solvency crisis. One failure triggers a cascade. Morgan Stanley is exiting now because they don't want to be in the room when the contagion starts. These three crises are not independent. They are self-reinforcing. They feed on each other in what Morgan Stanley calls the silver doom loop. It starts with inventory depletion. As inventory falls, traders get nervous. They decide to take delivery while they still can. This drains inventory further, which triggers more delivery requests. This is the first feedback loop. Then, as inventory crashes, the banks that are short silver realize they might be forced to deliver metal they don't. Possess. They panic. They try to buy physical silver to cover their shorts. But where do they buy it? From the COMEX warehouses, which drains inventory even faster. This is the second loop. Finally, the rising premiums in the physical market tell everyone that the paper price is a lie. This triggers a retail panic. People rush to buy coins and bars, which sucks more metal out of the system. 3 loops, all accelerating at once. Around and around, faster and faster, until the system implodes. Morgan Stanley's models show this feedback loop is already in motion. The acceleration phase has begun, and the window to exit closes at month end. This isn't the first time we've seen this. History is a graveyard of people who ignored institutional panic. In 1980, when the silver market reached its breaking point, the COMEX changed the rules overnight. They went to liquidation only. If you were long, you were wiped out in 2008 when the subprime mortgage crisis exploded. Banks like Goldman Sachs and Morgan Stanley were telling the public that everything was fine. But behind the scenes, they were aggressively unloading their toxic positions. Those who believed the public narrative lost everything in that crash. In 2022, when nickel spiked on the London Metal Exchange, the exchange simply canceled the trades. They deleted billions of dollars in profits to protect the short sellers. The lesson is clear. When the system is cornered, the authorities change the rules to protect the house. And Morgan Stanley knows the rules are about to change for silver. Why tell the clients? Why not just run silently? Liability. If Morgan Stanley exits their own book and lets their clients drown, the legal damages would be in the billions. By sending the memo, they create a paper trail. We warned you, we gave you the deadline. If you stayed, that's on you. But there is another reason they need a controlled retreat. If everyone panics and hits the sell button at the exact same second, the market crashes and Morgan Stanley can get their own money out. By giving a month-end deadline, they are spacing out the exits. They are managing the stampede. This isn't kindness, it's strategic self-interest. But here is the reality for you. The institutions who got the memo are exiting. They are following orders. But the retail investor, the person watching the screen and seeing $74, has no idea. They think the market is just having a bad day. They don't see that behind the scenes. The smart money is evacuating. When a major player like Morgan Stanley liquidates, it creates ripples, violent ripples. You will see the price spike on short covering, then crash on long liquidation. You will see intraday swings of $5 or $10. Margin calls will be triggered, leverage will be obliterated. But remember, the memo prioritized liquidation over price optimization. Morgan Stanley is willing to take losses just to get out. That tells you how dangerous staying in really is. So what is your move? You have 3 weeks, maybe less. That is your window. First, understand the divergence. Paper silver is becoming a liability. Physical silver is becoming an asset. If you are holding paper contracts, ETFs, or unallocated accounts, you are holding a promise from a bank that is currently running for the exit. You need to convert to physical metal while the windows are still open. Yes, you will pay a premium. Yes, it will be expensive, but that premium is the price of survival. Second, watch the inventory like a hawk every single day. If registered silver drops below 25 million ounces, the end is imminent. Third, hold what you have. If you already own physical silver, do not let the paper price volatility shake you out. When Morgan Stanley sells their paper long positions, the price might drop. It might drop to $70 or $65. Do not sell. That price drop is artificial. It is a result of forced institutional liquidation, not a change in the fundamentals. Once the exits are done, the price will snap back with a violence we have never seen. I know there are skeptics. I know you think this sounds extreme. You think Morgan Stanley is just rebalancing, but rebalancing doesn't involve the word exit. Rebalancing doesn't involve closing all positions. Rebalancing doesn't involve closing all new business. That is not routine, that is an evacuation. Ask yourself, why would they give up the revenue? Why would they risk the lawsuits? The only answer that makes sense is that they see something so catastrophic that staying in the market is not worth any amount of profit. They are willing to sacrifice their reputation just to get clear of the impact zone. Maybe they are wrong. Maybe the system holds, but are you willing to bet your net worth that the smartest risk managers on Wall Street are just being paranoid? I am not. When the largest institutional players start running for the exits, you don't need to see the flames to know there is a fire. Month end is the deadline. Month end is when the regulatory reporting hits. Month end is when the Basel III requirements expose the truth. Morgan Stanley wants to be sitting on a pile of cash when the music stops. The countdown has started. The exits are being jammed. You have been given the intelligence that most people will only read about in history books after the crash. Use it. Use the fact that you know what Morgan Stanley is doing. The memo is real. The deadline is real. The silver is disappearing. Exit your paper positions. Secure your physical metal. And do it now.